Lundh is the principal economist at the Conference Board. He joins us live now from New York. Erik, thank you so much for being with us. So the Fed holding interest rates steady. Just walk us through whether you think this was the right decision.
I think it was a pretty widely anticipated decision. Markets had priced in a pause at this meeting. We've seen 525 basis points worth of hikes really since 18 months ago. So there's a lot of tightening that's already occurred. The Fed is really just trying to suss out where is it going to finally land in terms of a terminal rate. We've seen some really great growth numbers. We've seen some progress on inflation, but Powell and the FOMC have really not really found a position in the economy quite yet where they're comfortable with really putting things on pause at this point.
I mean, when you think about it, the economy is so healthy, so strong, so resilient. At the same time, though, the interest rate hikes of past have really made things difficult financially for households and businesses. I mean, it really is such a fine line that the Fed has to walk here.
It is, and Powell talked about that a little bit today at the press conference. He said that, the risks were more symmetric at this point, that a year ago the risk was, about not tightening enough. And now it's really about, do we have the rate right where we can get to 2%, which is the inflation target, without really having a dire impact on the economy. We did see some great GDP growth in Q3. That was really driven by the consumer. But if you look at things like business investment, that was about flat for the quarter, which really shows that some of the tightening that we've already seen is having an impact in terms of businesses' willingness to invest.
Given that, just looking at some of the data points here, third quarter GDP coming in at 4.9%, consumer spending strong, not to mention unemployment rate at staggeringly low. How much risk is there at this point, though, to keeping rates unchanged?
Well, I mean, the risk is, I think, from the Fed's perspective that, letting go too quickly is going to present an environment where we don't get to 2% for a long time. That's one of the primary objectives. Powell has made it very, very clear, meeting after meeting, that 2% is where we're going to get, even if it means pushing the economy into a slower growth environment. I mean, from our perspective, we have seen the consumer really just drive growth this year for a variety of reasons: pandemic excess savings, revenge spending on things like vacations and travel. But we're also seeing debt levels rise. Credit card debt is up to about $1 trillion now. We're seeing personal income growth start to cool on an inflation-adjusted basis. So moving into 2024, we're a little bit more pessimistic in terms of the growth outlook. We think we could see a couple of quarters of even negative growth in early 2024.
All right, so the worst is yet to come. Erik Lundh, live for us there. Thank you so much. Appreciate it.